Welcome back to the deep dive. Today we're going to be taking a close look at some finance sources you've shared, which cover day trading strategies, some interesting biotech outlooks, and the overall market mood going into 2025. So if you're trying to figure out some smart investing moves this year, well, stick with us.
Yeah, it's an interesting mix of tactical advice and the bigger economic picture, so should give you a well-rounded view.
For sure. So to kick things off, let's dive right into some day trading strategies from Benzinga Co. They've got this great tutorial using the stock ticker AFRM as a real-world example, and I think you'll appreciate how they really break down their approach to price action into three core elements.
I'm always interested to hear about actionable strategies, so yeah, let's hear it.
Okay, first up, support and resistance levels. Think of these as the battle lines on a stock chart, right? Where the buying and selling pressure are kind of clashing. And the tutorial shows you how to, pinpoint these levels using moving averages, Bollinger Bands, and even just like past price action.
Right. Yeah, it's fascinating how those techniques can help visualize the history of the stock's struggle to break through certain price points, and by understanding those patterns, you can anticipate potential turning points and make smarter trading decisions.
Exactly. And then we've got wicks. Those are the little tails above or below a candlestick on the chart. And they can be really strong signals that a reversal is coming.
Yeah, wicks often signal a rejection of price at that level, hinting that the momentum is about to shift. So learning to read them well can give you a real edge in day trading.
Yeah, for sure. And Benzinga Pro does a great job explaining how to interpret those wicks like a pro. And then, of course, you've got to factor in volume. It's the fuel for any stock move. And the tutorial really emphasizes how those volume changes can confirm your trades or, warn you that something might be a head fake.
Right. Without enough volume, even the most promising price action patterns can be misleading. It's all about the conviction behind those price movements, and volume can help you really understand that.
Exactly. So what's really cool about the Benzinga Pro strategy is it really emphasizes observation and pattern recognition. You're not relying on complex algorithms or anything like that. You're really just learning to read the story that the market's telling you through price action.
That's interesting. But that raises the question, can this strategy be consistently applied? Day trading takes a lot of practice, discipline, and a keen eye for detail. It's not for everyone, but if you can master these skills, it could be really lucrative.
Yeah, for sure. Now, let's switch gears a bit and look at biotech. We've got some interesting takes on Moderna and all the buzz around GLP-1 drugs. And one analyst we follow isn't too optimistic about Moderna, especially after their recent earnings miss and lowered sales guidance.
Yeah, Moderna is definitely facing the challenge of declining COVID vaccine sales, but they do have a pretty robust pipeline of other promising treatments, right? They've got a bunch of phase 3 trials going on, including a potential cancer vaccine and a norovirus treatment. So while the near-term profitability might be uncertain, their long-term potential is still very much alive.
So it's kind of like a gamble then. Big bets on future treatments, but yeah, profitability in the short term, that's the question mark.
Yeah, high risk, high reward, potentially for investors with a long-term view. Now, this analyst is actually quite bullish on the outlook for GLP-1 drugs, which are used to treat type 2 diabetes and obesity.
You mean like Ozempic, the one everyone's talking about?
Exactly, Ozempic. But there are others being developed by companies like Amgen and Eli Lilly. These drugs are generating a lot of excitement because they've shown remarkable efficacy in managing blood sugar levels and promoting weight loss.
Yeah, I've heard that some patients have actually achieved substantial weight loss using them, which explains why they're so popular.
Right, and this analyst really sees a bright future for these companies, citing strong clinical data and the potential for regulatory action against the cheaper compounded versions of GLP-1 drugs, which could really benefit the brand name drug manufacturers.
Wait, compounded versions, what does that mean?
Compounded drugs are essentially custom-made formulations, created by pharmacists. They could be a lot cheaper than their brand name counterparts, but they may not meet the same quality and safety standards. The FDA's voiced some concerns about the increasing use of these compounded GLP-1 drugs, and there's a chance they might step in and restrict their availability.
Oh, interesting. So if the FDA does crack down on those compounded versions, that could be a huge win for companies like Amgen and Eli Lilly.
Exactly. It could lead to increased market share and, potentially translate into higher revenue and profits.
Wow. Okay, so we've got a potentially risky bet on Moderna's future and a brighter outlook for those developing GLP-1 drugs. Now let's zoom out and look at the bigger picture, those overall market trends emerging in early 2025.
Yeah, it's important to understand that context, right?
Absolutely. So we've got insights from CNBC and Yahoo Finance, and it looks like things are a little uncertain. The S&P 500 is nearing record highs, but investor sentiment is still pretty cautious.
It's an interesting dynamic, right? You've got these positive economic indicators, but there are still concerns about inflation, geopolitical risks, and even, new tariffs.
Right. Speaking of tariffs, President Trump is back with his reciprocal tariffs plan, where the U.S. would basically match tariffs imposed by other countries on American goods. But there seems to be some hesitation to actually implement this plan.
Yeah, I mean, the potential for a global trade war is a serious concern, especially when you consider the impact it could have on consumer prices and economic growth. It's a complex issue with no easy answers, and that uncertainty can definitely make investors nervous.
Absolutely. And then there's inflation, of course. Recent CPI and PPI reports are sending mixed signals, so everyone's kind of left wondering what's next.
It's a puzzle economists are still trying to figure out. There are some signs that inflation might be cooling down, but it's too early to say for sure.
Yeah, it's a bit of a waiting game. So, amidst all this uncertainty, Thomas Martin, a senior portfolio manager at Global Al Investments, is emphasizing the importance of earnings and sustainability in stock selection. And I think that's a really valuable takeaway for our listeners.
Absolutely. In a volatile market like this, focusing on companies with strong fundamentals is crucial. Martin's approach reminds us that hype can be fleeting, but those solid fundamentals are the foundation for lasting success.
Right, and he suggests looking for companies with expanding total addressable markets, revenue growth, and expanding margins. Basically, don't just chase the hype, chase the substance.
I like that. Substance over hype. So are you ready to dive into some specific stock picks? We've got a lot to cover.
Yeah, let's do it. I'm curious to hear what these analysts and portfolio managers are recommending. First up, we have Vertiv, a company that makes cooling systems for data centers. They're currently benefiting from the AI boom, but there are some concerns about their future growth outlook. What are your thoughts?
Vertiv's in an interesting position. The data center market is definitely poised for major growth in the coming years, driven by that increasing demand for computing power. However, investors are a little wary of Vertiv's ability to actually capture that growth and maintain profitability. It's a classic growth versus value dilemma.
Interesting. Okay, then we have Unilever, the consumer goods giant. They're facing some headwinds from slowing sales and currency fluctuations. Is this a buying opportunity, or are there some deeper issues we need to consider?
That's a good question. Unilever is a huge company with a ton of well-known brands. But like many multinational companies, they're vulnerable to those currency fluctuations that could impact their earnings. Plus, they're facing challenges with organic sales growth, which suggests that some of their brands might be losing their appeal.
And let's not forget their plan to spin off their ice cream unit, which could unlock some value, but it definitely adds another layer of complexity for investors. And then there's Kraft Heinz, facing similar challenges with organic sales growth and also considering potential divestitures.
Kraft Heinz is a perfect example of a company struggling with a mature market and changing consumer preferences. Divestitures can help streamline operations and allow companies to focus on their core strengths, but they can also be disruptive and lead to a loss of revenue. It's a tricky balancing act.
For sure. Okay, let's move on to something a little different. RM Holdings, a chip designer, has reportedly secured Meta as a client for their own chip, but here's the twist. They could be entering into direct competition with some of their biggest customers like Apple and Qualcomm.
Right. ARM Holdings is stepping into uncharted territory. It's a bold move that comes with some inherent risks. They could end up alienating their existing clients who might see them as a competitive rather than a partner. But if they can successfully pull this off, they could become a real powerhouse in the chip market. It's a high-stakes gamble with the potential to shake things up.
And speaking of high stakes, we have Coinbase, the cryptocurrency exchange. They're reporting strong earnings, but they're also facing potential competition from those traditional finance firms.
Coinbase has definitely benefited from the surge in popularity of cryptocurrencies. But as crypto goes mainstream, it's attracting the attention of those big players in traditional finance who have the resources and infrastructure to challenge Coinbase's dominance. It's a classic battle between the disruptor and the incumbent. It'll be interesting to see how this plays out.
Okay, so we've got a bunch of intriguing stocks and potential investment opportunities to think about. Now, before we wrap up this part of the deep dive, let's touch on the global trade landscape. Things are getting pretty tense with President Trump's reciprocal tariffs plan causing quite a stir.
Definitely this plan where he's advocating for matching tariffs imposed by other countries on American goods has raised some serious concerns about a potential global trade war, with the potential impact on consumer prices and economic growth.
Right. Our sources from CNBC and Yahoo Finance highlight those concerns. Critics are saying that these reciprocal tariffs could spark a global trade war, driving up prices for consumers and businesses, and ultimately hurting economic growth. There are also questions about whether this approach would even work to reduce trade deficits. Some economists are saying that trade deficits are actually influenced by a bunch of different factors, like domestic savings and investment rates, and that simply raising tariffs might not be the best solution.
It's a super complicated issue with a lot of potential consequences, and that uncertainty is making it hard for businesses and investors to figure out how to navigate the global trade landscape.
Okay, now let's shift gears again and look at some of the individual companies that stood out in our research, starting with ARM Holdings. Their decision to develop their own chip and potentially go head-to-head with their own customers is a pretty bold move, and it could really change the tech world as we know it.
ARM Holdings is known for designing the underlying architecture for a lot of the chips used in smartphones and other devices. So their move to create their own chip and potentially compete with giants like Apple and Qualcomm is a risky move, but it could pay off big time. They're basically putting all their faith in their chip design expertise, hoping it'll give them an edge in that increasingly competitive semiconductor market.
Our source from CNBC points out that this could create some tension with their existing customers. They might not be too happy about ARM Holdings suddenly becoming a competitor.
Yeah, managing those relationships is going to be crucial for ARM Holdings. They'll need to be really careful not to alienate their current customer base while also trying to establish themselves as a competitor. It's a delicate balancing act with the potential for major disruption in the chip market.
Okay, let's move on to GameStop, the video game retailer that became a meme stock sensation back in 2021. They're considering a pretty unconventional investment strategy, exploring the possibility of investing in Bitcoin and other cryptocurrencies.
According to CNBC, this move aligns with their recent efforts to transform into a more tech-focused company. But it sparked some skepticism among analysts who are questioning whether GameStop actually has the know-how to navigate the world of cryptocurrencies, which can be really volatile. It's a high-risk, high-reward gamble that could either make them a lot of money or end up being a disaster.
Let's switch gears to earnings reports. Twilio, a cloud communications platform, missed earnings estimates slightly for the fourth quarter, and their first quarter profit forecast fell short of Wall Street's expectations.
Twilio is facing a challenge that's common for a lot of growth companies, maintaining that momentum in a competitive market. Their focus on platformization, integrating all sorts of communication tools into a single platform, is a big part of their strategy. But investors are worried about their ability to actually execute that vision and achieve consistent profitability. They need to show some results to reassure investors that they can handle the challenges ahead.
Another company dealing with similar challenges is Dexcom, a maker of continuous glucose monitors for people with diabetes. They reported fourth quarter revenue that met expectations, but their full-year revenue guidance wasn't as good as analysts had hoped. It seems they're facing a tough battle to maintain their growth in the diabetes device market, which is getting more competitive all the time.
Absolutely. Dexcom can't afford to rest on their laurels. They need to keep innovating and expanding their product line if they want to stay ahead of the curve in this fast-paced market.
And then we have Unilever, the consumer goods giant, who, like a lot of companies these days, are dealing with slower sale growth and currency fluctuations. Their recent earnings report highlighted these headwinds, and investors are anxious to see what their plan is for navigating these choppy waters.
Unilever has a long history of adapting to changing market conditions. They have a huge portfolio of brands, and they're constantly innovating and adjusting their products to meet changing consumer tastes. They're also focusing on controlling costs and improving efficiency to lessen the impact of currency fluctuations and rising input costs. They're a resilient company with a proven track record.
So it sounds like they're being proactive about tackling the challenges they're facing rather than just hoping for the best.
Exactly. They're not just sitting back and waiting. They're taking concrete steps to deal with the current headwinds. We'll have to see how effective their strategies are in the long run.
Okay, let's circle back to inflation. It's a major concern for both investors and consumers, and we've got some interesting perspectives from economic experts who've been analyzing the latest CPI and PPI reports.
These reports give us a snapshot of what's happening with inflation right now, and these experts offer valuable insights into what it all means for the economy and for the Federal Reserve monetary policy.
One expert, Ben Evans from FedWatch Advisors, is worried about the upward trend in inflation, especially when you look at the overall CPI number. He thinks those recent tariffs on goods from China are starting to have an impact on consumer prices, and he expects inflation to keep rising in the coming months.
Those tariffs are a big unknown in the inflation equation. They make an already complex situation even more complicated.
Emmons also talked about how important inflation expectations are. He says that if consumers and businesses think prices are going to keep going up, they might start acting in ways that actually contribute to more inflation. For example, they might demand higher wages or raise the prices of their own products and services, which would create a self-fulfilling prophecy.
It's a vicious cycle that the Federal Reserve is trying hard to avoid.
And Philip Luke, another expert, agrees with Emmons about the impact of tariffs on inflation.
Luke points out that even if tariffs don't directly affect the prices of certain goods, they can still have indirect effects. If tariffs make things like steel and aluminum more expensive, those higher costs can ripple throughout the economy, eventually making all sorts of products more expensive.
It's a domino effect that's hard to control.
Exactly.
Luke Alma mentioned that tariffs make businesses uncertain about the future, so they're less likely to invest and expand, which can slow down economic growth and potentially even make inflation worse. So these tariffs are a big worry for economists and policymakers.
They're a multifaceted issue with major implications for the economy as a whole. And it's not just tariffs that we have to worry about. Supply chain problems, strong consumer demand, and rising energy prices are all playing a role in this inflationary environment.
It's a complicated problem that needs a comprehensive solution. And the Federal Reserve has a tough job ahead of them, trying to keep inflation in check while also supporting economic growth.
It's a balancing act for sure. Their decisions are going to have a big impact on the market and the economy as a whole. They need to make the right moves.
So we've got a volatile market, uncertain economic conditions, and the threat of tariffs hanging over our heads. It's a lot to take in, but that's why we do these deep dives, to help you make sense of it all.
Exactly. We want to give you the information, analysis, and context you need to make smart decisions about your investments.
Now let's take a moment to think about everything we've learned and figure out how to apply it to your own investment goals.
It's definitely been a lot of information so far. I think that's what makes these deep dives so valuable, you know. You get this like condensed, carefully curated perspective on these really complex topics, so it saves you a ton of time trying to like research and filter everything yourself.
Exactly. We're all about delivering those key insights without the overwhelm. But speaking of feeling overwhelmed, things are getting pretty tense in the global trade arena.
Yeah, President Trump's reciprocal tariffs plan is causing quite a bit of anxiety in the markets. He's basically saying that the U.S. should put tariffs on goods from countries that have higher tariffs on U.S. goods.
Yeah, he says it's about leveling the playing field, but our sources from CNBC and Yahoo Finance are highlighting some serious concerns with this approach.
Rightfully so. Critics are saying that this could start a global trade war, which would mean, higher prices for everyone and ultimately hurt economic growth.
And there are also doubts about whether the strategy would even work to, actually reduce trade deficits. Some economists are arguing that trade deficits are influenced by all sorts of things like domestic savings and investment rates, and that just raising tariffs might not be the most effective solution.
It's a really complicated issue with no easy answers, and it's definitely creating a lot of uncertainty, which makes it hard for businesses and investors to figure out how to navigate the global trade landscape.
Definitely a lot to think about there. Now let's shift our focus to a company that's really shaking things up in the tech live. ARM Holdings, a chip designer, is they're making some pretty bold moves.
ARM Holdings is definitely one to watch. They design the underlying architecture for a lot of the chips that are in, our smartphones and all these other devices.
And now they're like taking this huge leap by developing their own chip, which could put them in direct competition with some of their biggest customers, like Apple and Qualcomm.
It's a risky move, but it could have a big payoff if they're successful. They're essentially betting on their chip design expertise to give them a competitive edge in the semiconductor market, which is becoming increasingly fierce.
Our source from CNBC points out that this could create some real tension within the industry. ARM Holdings customers might see this as as kind of a betrayal, like they're no longer partners, now they're competitors.
Absolutely, it's a really delicate situation for ARM Holdings. They need to be careful not to alienate their existing customer base while also trying to position themselves as a competitor. It's a tightrope walk, but the potential for disruption in the chip market is pretty huge.
Now let's talk about GameStop, the the video game retailer that became a meme stock phenomenon back in 2021. They're apparently considering a pretty unconventional investment strategy.
According to CNBC, GameStop is exploring the possibility of investing in Bitcoin and other cryptocurrencies. It's definitely a bold move for a company that's traditionally been focused on brick and mortar retail.
It's definitely a change from their core business, but it does seem to align with their recent push to kind of transform themselves into a more technology-focused company.
Right. But not everyone is convinced. Some analysts are questioning whether GameStop actually have the expertise to really succeed in the world of cryptocurrencies, which can be incredibly volatile. It's a high-risk, high-reward gamble, and it could go either way.
Let's move on to some earnings reports. Twilio, the cloud communications platform, recently reported earnings that were just slightly below analyst estimates for the fourth quarter, and their forecast for the first quarter also fell short of Wall Street's expectations.
Twilio is facing a challenge that a lot of growth companies struggle with, which is how to maintain that growth momentum in a competitive market. A big part of their strategy is this focus on platformization, which is basically integrating all sorts of different communication tools into a single platform. But investors are a little bit worried about their ability to really execute on that vision and achieve consistent profitability.
Yeah, they need to deliver some results to kind of prove to investors that they can, that they can overcome these challenges.
Absolutely. Now, let's look at Dexcom, a company in the healthcare sector that makes continuous glucose monitors for people with diabetes. They recently reported fourth quarter revenue that met expectations, but their full-year revenue guidance fell short of what analysts were hoping for.
It seems like they're facing a similar challenge to Twilio, which is, trying to maintain growth in a market that's becoming increasingly competitive. The diabetes device market is constantly evolving with new technologies and competitors emerging all the time.
Yeah, they can't afford to get complacent. Continuous innovation is key, and they need to keep expanding their product offerings if they want to stay ahead of the curve.
Let's bring our attention back to Unilever. They're facing some headwinds, like a lot of companies these days with slower sales growth and currency fluctuations. Their recent earnings report highlighted these challenges, and investors are eager to see how they plan to navigate these choppy waters.
Unilever has a pretty impressive track record of adapting to changing market conditions. They've got this huge portfolio of brands, and they're constantly innovating and adjusting their product mix to keep up with changing consumer preferences. They're also really focused on cost optimization and efficiency improvements to try and mitigate the impact of currency fluctuations and rising input costs.
So it sounds like they're taking a proactive approach to addressing these challenges rather than just kind of hoping for the best.
Exactly. They're not being passive. They're actively taking steps to deal with the current headwinds. We'll have to wait and see how effective their strategies will be.
Now, let's circle back to the topic of inflation. It's a major concern for everyone, investors and consumers alike. And we have some interesting insights from economic experts who have been analyzing the latest CPI and PPI reports.
These reports give us a snapshot of what's going on with inflation, and these experts offer some valuable perspectives on what it means for the economy and for the Federal Reserve's monetary policy.
One expert, Ben Emmons from FedWatch Advisors, expressed some concern about the upward trend in inflation, particularly when you look at the headline CPI number. He thinks the recent tariffs on goods from China are starting to have a real impact on consumer prices, and he expects inflation to continue rising in the coming months.
The tariffs definitely add another layer of complexity to an already delicate economic balancing act.
And Emmons also highlighted the importance of inflation expectations. He's saying that if consumers and businesses, if they believe that prices are going to keep going up, they might start acting in ways that actually fuel further inflation. Like, for example, they might demand higher wages or raise prices for their own goods and services, which would create this sort of self-fulfilling prophecy.
It's a dangerous cycle that the Federal Reserve is working hard to prevent.
And Philip Luke, another expert we follow, echoed Emmons's concerns about the impact of tariffs on inflation.
Luke emphasized that even if tariffs don't, directly affect the prices of certain goods, they can still have these indirect effects. So, like, if tariffs make things like steel and aluminum more expensive, those higher costs can ripple through the economy and eventually lead to price increases for all sorts of different products.
It's a domino effect that can be really hard to control.
Exactly.
Luke also pointed out that tariffs create a lot of uncertainty for businesses, which can make them hesitant to invest and expand. And that can lead to slow economic growth, which could potentially even make inflation worse. So yeah, the tariffs are a major concern for both economists and policymakers.
They're a very complex issue with far-reaching implications for the economy. But it's not just about tariffs. We also have to consider, things like supply chain disruptions, strong consumer demand, and rising energy prices, which are all contributing factors to the current inflationary environment.
It's a multifaceted problem, and it requires a multifaceted solution. And the Federal Reserve has this really difficult task ahead of them, trying to control inflation while also supporting economic growth.
It's a very delicate balancing act. The decisions they make are going to have a significant impact on the market and the economy as a whole. It's really important that they make the right moves.
Okay, so it's that this volatile market, uncertain economic conditions, and the threat of tariffs hanging over our heads. It's a lot to digest. But that's what these deep dives are for, right? To help you navigate this complex landscape.
Exactly. We want to provide you with the knowledge and insights you need to make informed decisions about your investments. We're giving you the pieces of the puzzle. It's up to you to assemble them and develop your own investment strategy.
So let's take a moment to reflect on what we've learned and figure out how we can apply this knowledge to your individual investment goals. We've covered a ton of ground in this deep dive, right? From those day trading tactics to biotech outlooks and the overall market sentiment. So, we've explored on this information. Now it's time to kind of synthesize it and figure out, okay, how does this apply to your investment strategy?
You've shared a really fascinating mix of sources, and I think what's really striking is the convergence of themes. It's becoming increasingly clear that we're in a stock picker's market. Analyzing individual companies is becoming more important than just riding those broad market trends.
So just buying the S&P 500 and hoping for the best might not be the best strategy anymore.
Exactly. This environment demands a more discerning approach. Our sources all emphasize this, the importance of really focusing on earnings, sustainability, and companies that demonstrate that genuine potential for long-term growth.
It reminds me of, Thomas Martin's advice to look for companies with expanding total addressable markets, revenue growth, and expanding margins. He's basically saying, look for substance over hype.
Exactly. Hype can be fleeting, but those solid fundamentals, that's the foundation for lasting success in the market.
All right, so now let's turn the focus to you. What really stood out to you from everything we've discussed? Was it a specific stock, a market trend, or maybe just a fresh perspective on investing in general?
Yeah, I'm curious to hear your thoughts. This is where active listening becomes really important. It's not just about, absorbing information. It's about internalizing it, figuring out how it applies to your specific situation, your own investment goals.
We've thrown a lot of information at you, but remember, investing is a marathon, not a sprint. The key is to stay informed, be adaptable, and never stop learning.
And that's what these deep dives are all about. We provide the information, the analysis, the context. But ultimately, the decisions are yours to make.
Speaking of decisions, I have one final thought-provoking question for you to consider as continue on your investment journey. We've touched on the potential impact of AI on, various industries, but what about the impact of AI on investing itself?
Ooh, that's a fascinating question. Imagine algorithms that can analyze massive amounts of data, identify patterns that humans might miss, and make investment decisions like instantly.
And it's already happening. We're seeing the emergence of these AI-powered trading platforms and robo-advisors, and that trend is only going to accelerate in the coming years.
Right, which leads to an even bigger question. What role will human investors play in a world where AI is, increasingly calling the shots? Will it be a partnership, a competition, or maybe even a completely new paradigm? It's definitely something worth exploring.
It's a topic we didn't specifically address with the sources you shared, but it's a fascinating area for further research and thought.
And that's the beauty of a deep dive like this. It often sparks more questions than it answers, and it can send you down these new paths of discovery, further deepening your understanding of the ever-evolving world of finance.
Well, we hope this deep dive has been insightful and helpful in guiding your investment decisions. And remember, investing is a journey, a continuous process of learning, adapting, and refining your strategies.
Until next time, happy investing. We're looking forward to diving into some new and exciting topics with you in our future deep dives.